Welcome back to the deep dive. Today we are tackling one of the biggest questions in business, one that really trips people up,
Hmm.
and that is, how do you know if a company is truly successful or if it's just, busy? We're diving into accrual accounting and we're going way beyond just tracking cash.
Exactly. I mean, if you only judge success by what's in the bank, you're missing, what, 90% of the story?
Right.
The whole point of accounting really is separating the economic value a company creates from the timing of cash.
Yeah.
Everyone thinks cash is king. Accrual accounting is built to prove that idea wrong.
And we have some fantastic material to work with today. You shared the financials from Veda's company, which is a perfect case study.
It really is.
So our mission is to use these transactions, the sales, the payments, to give you a real shortcut to understanding what financial health actually looks like.
We're basically taking these, day-to-day business events and translating them into the language of the three financial statements.
Yeah.
This isn't just bookkeeping. It's about valuation. And we're going after one ultimate indicator. The clearest sign of success is a growing retained earnings balance. That $500,000 figure we see later, that's the proof that Veda's creating and keeping value in her business.
Okay, so let's unpack that. Let's start right where the value gets created. Revenue. We've got transactions 10 and 11. Most people think revenue is just getting paid. But what's the actual rule here? What does Veda have to do to recognize a sale?
The rule is called the revenue recognition concept, but let's simplify it. I like to think of it as the asset creation test.
The asset creation test. Okay.
So when Veda sees a new asset pop up on her books, it could be cash, could be an IOU, what we call accounts receivable, she has to ask herself, where did this come from?
And there are only so many places it can come from, right?
Only three, really. You either borrowed it, which creates a liability,
A loan.
or an owner invested it, which is equity, or, and this is the key part, if it's neither of those, it must have been earned. Its source is revenue.
That's a very clean way to frame it. So let's apply it. Transaction 10. Veda sells inventory for $1.1 million. She gets some cash, some on credit.
Right. So she has new cash, and she has new accounts receivable. Neither came from a loan, neither came from an owner. Therefore, bang, $1.1 million in sales revenue gets recognized right then and there.
And transaction 11, the consulting services, is even clearer.
$200,000, all on account, no cash at all. But she created a solid asset that promised to pay. That asset is proof she delivered the value. So that $200,000 is revenue.
So the big insight for you listening is that for Veda, revenue happens when she delivers the goods or finishes the service. It has nothing to do with when the money actually shows up.
That is the absolute core of accrual accounting. That accounts receivable, that promise, is enough.
Okay, but here's where it gets really interesting. Let's jump straight to transaction 12, because this one involves a lot of cash but zero revenue. Veda collects $160,000 for work she did last month, work she already recorded as revenue. So why does the income statement completely ignore this cash?
Because she didn't create any new value. The economic event, the earning, already happened. This is just a cleanup operation on the balance sheet.
A cleanup operation.
We call it an asset exchange. It's a really important concept.
An asset exchange. Okay, walk me through that, because this is where a normal checkbook-style thinking just completely falls apart.
So think about her balance sheet. On one side, her cash asset goes up by $160,000. Great. Everyone's happy.
Smiles on our faces, like the source material said.
Exactly. But at the same exact time, her accounts receivable asset goes down by $160,000. She just swapped one asset for another.
So her total assets didn't change at all.
Not by a penny.
Uh-huh.
And crucially, her retained earnings, her profit, is completely unaffected. All she did was improve her liquidity. She has more cash to pay bills, but she's not $1 richer in terms of profit for the month.
So confusing strong collections with strong sales. That's a classic mistake.
A huge one. This is a cash flow event, not an income event.
Okay, so that brings us to profitability. Revenue is just one side of the coin. We need to bring in this idea of matching to see what Veda actually made.
Right, the matching concept.
For that $1.1 million in sales in T10, how does she figure out what she really created in value?
The matching concept is simple, but it's powerful. It just demands that for every dollar of revenue you earn, you have to record at the same time the expenses that made it possible.
Cause and effect.
You match the cause, the expense with the effect, the revenue. So in T10, to make that $1.1 million, she had to give something up.
The inventory she sold, it cost her $800,000.
Correct. And that $800,000 is immediately recorded as an expense called cost of goods sold, or COGS,
So if she only booked the revenue, her profit would be wildly overstated.
by $800,000. By matching, we see T10 only really increased her wealth, her equity, by $300,000. That's the actual value created.
And that makes the $200,000 from consulting in T11 look even better because there's basically zero direct cost to match against it.
Exactly. The margins are totally different. And all of it circles back to our ultimate scorekeeper.
Retained earnings.
Retained earnings. These revenues and expenses, they're just temporary accounts. At the end of the day, revenue increases, retained earnings and expenses decrease it. It's the running total of every bit of value Veda has ever earned and kept in the business.
Let's shift gears to another thing that trips people up. Paying bills. Transaction 15, Veda pays $1.2 million cash to her suppliers. A huge cash outlay. Why is that not an expense?
Because the expense already happened.
Way earlier.
Probably, yeah. The expense happened when she used the inventory or the supply she bought on credit. That was already matched to a sale. Key 15 is just Veda making good on her promise.
So when she first got the stuff from the supplier, she recorded inventory up and a liability accounts payable up.
Perfect. And when she sold it, she recorded the expense, COGS. So T15 is just a balance sheet transfer. Cash goes down, the accounts payable liability goes down, the income statement doesn't even notice.
Which makes sense. If she booked that as an expense now, she'd be counting the same cost twice.
And she'd look like she was losing a ton of money this year, when she isn't.
This leads us right into the real power of accruals, payroll. It's messy because it crosses time periods. Let's look at transaction 16, wages. This is where accrual accounting really proves its worth.
It really does. Because T16 shows us that an expense isn't just cash going out the door. It's assets being consumed or liabilities being created.
Okay, break that down.
So Veda's employees worked all year to generate this year's revenue. Part one of the expense is the cash she actually paid them.
The $460,000, that's assets consumed.
Exactly. But they also worked the last week of December. They earned another $40,000 that they won't get paid until January.
Ah, so she has to account for that now.
She has to. That labor helped make this year's sales. So she creates a liability, an IOU, to her employees for $40,000. We call it wages payable.
So the true expense on the income statement is the full $500,000.
Yes.
Yeah.
It has to be to match against this year's revenue. And look at how the equation balances. Assets went down by $460 cash. Liabilities went up by $40,000. And equity went down by the full $500,000 expense. It all ties out perfectly. It tells a much richer story than just saying cash paid was $460K.
Okay, now let's look at the complete opposite of that, transaction 19. This time, Veda gets cash before she does the work. $50,000 for a franchise agreement.
Right. So using our asset creation test, she has a new asset, cash.
50 grand.
But did she deliver the value? No. She still owes the service. So it cannot be revenue.
Oh, it's an obligation.
It's a liability. It's called unearned revenue.
Mm-hmm.
It just sits on her balance sheet as a debt she owes to the customer. Once she performs a service, then and only then does the liability disappear and revenue gets recognized.
It's like a ticking clock waiting to be earned.
That's a great way to put it.
And just quickly, transactions 17 and 18, the general expenses, rent, ads, utilities, $150,000 total. These are treated as immediate expenses. Why is that different from inventory?
Because the benefit is consumed immediately.
Yeah.
You pay for an ad, the benefit happens now. You use electricity, you consume it now. There's no future value sitting on a shelf, so you have to match that cost to the current period's revenue right away.
Okay, so this whole deep dive really comes down to one thing. You need all three financial statements to see what's really going on.
You absolutely do. You can't just use a checkbook. Each statement has a very specific job. The income statement tells you if Veda actually created value over the year. It shows that $500,000 wage expense, that $300,000 profit on goods, it measures her economic performance.
And the balance sheet is the snapshot in time. It shows where she stands. It shows the cash, sure, but it also shows that $40,000 wage liability.
And the $50,000 she owes on that franchise deal.
Right, and then you have the statement of cash flows.
Which explains why the cash changed. That's where transaction 12, the cash collection, finally gets its moment in the spotlight. It's a huge cash inflow from operations. It explains why Veda might feel flush with cash, even if sales that particular week were slow.
So the big takeaway for you listening has to be separating those ideas. Profitability on the income statement and liquidity on the cash flow statement, they are not the same thing.
Not at all. I mean, a company can look amazingly profitable, But if customers aren't paying, it will go bankrupt. And a company can have tons of cash, maybe from a loan, but be losing money on every single sale. Accrual accounting forces you to see both sides.
That's a perfect summary. We've really hit the big aha moments. Revenue is about delivery, expense is about consumption, and paying a debt that's just moving money around on the balance sheet.
And following these rules, these accrual rules, is what ensures the final reports are accurate. It's what moves accounting beyond, just counting cash and turns it into a real tool for measuring performance.
And to leave you with a final thought, something for you to chew on. The source material mentioned that Veda uses two different revenue accounts, sales revenue and consulting revenue. Now, why would she bother doing that? Think about the practical use of all this. It's a principle we call segment reporting. By keeping those streams separate, Veda can analyze which part of her business has better margins, which one is more profitable. That data is what tells her where to invest her time and money next year. That's how this foundational knowledge becomes a strategic weapon for the business.